Let's talk Q4 numbers with Kiran Majumdar-Shaw, CMD of Biocon. She joins us live from Bangalore. Shaw, good morning. Thank you for joining us. First, a word on how things have moved for Biocon for the quarter gone by, because if I cut and dissect numbers, there is good news and there is bad news.
Well, I don't think there is bad news per se. I think there's a lot of good news. I think we've done extremely well this fiscal and this quarter. We have seen the surge in our PAT because of the exceptional income that we have recognized thanks to relicensing our insulin's analogs portfolio to Mylan. I think that's a very positive news, and on the back of which we are actually declaring a 50% special dividend. We also are, in addition to that, declaring 100% normal dividends, which sort of then brings the total dividend to 150% or 7 rupees 50 paise per share. So I think from that point of view, it's good news. If you look at our other performance, I think our research services have done exceedingly well. I think we've seen a 36% surge in growth. Research services themselves have accounted for 98 crores of profit. This is a business that is just growing stronger and stronger because of its differentiated offering, and we are very, very optimistic about the growth and future of this business. As I mentioned earlier, we are second only to WuXi Pharma in China, but we are clearly market leaders by way ahead of everybody else. I think that's a huge credit to our this particular business. If you look at our biopharma business, even that has done exceedingly well. I think we have grown excluding branded formulations, we have grown 10% year on year, which itself is a good growth given the capacity constraints that we look at. It's a better product mix. The branded formulations have also grown 34%, and as I mentioned earlier, it's a very important differentiated offering that we have, because more than 50% of our products are biologics. I think no other company in India can, really claim that kind of a differentiated offering in the branded formulation space, which, as you know, can be a very commodity play. I would also like to mention here, our research spends have increased 20% to 164 crores, and our tax has actually almost doubled to 98 crores. So I think you have to look at it in that context. I think we've had a very good quarter, very good year, if you dimension all these things together. So that's my comments and my take on our performance.
Right, Vishwa. While we take that on board, but there seems to be some disconnect there, because the stock is down 3%. And if I just look at the estimates that the market had, yes, CRAMS has done extremely well, but your biopharma revenues have been way below estimates. People were expecting a growth of about 8 to 10%. There's been a fall of about 2% there. And on the margin...
Well, there has been a 10% growth.
That's on your biopharma revenues?
Yes.
What about overall margins then, which have come in also a bit lower than expected?
Well, margins have done well. I think margins are fairly good. I mean, I would say that you have to look at it in context of various things. I think the biggest problem is that investors don't want us to spend on R&D. And I think R&D is a very integral part of our business. It is a value creator. It's a value driver. You will, R&D investment actually has two streams of realizations. One is sales itself. If you just look at our insulin's investment, and you can see the kind of revenue that we have, derived from insulins and from the licensing income. It is a huge return on that R&D investment. I think people don't get it. I think people do not want, they look at it as a one-off income. It is not a one-off income. Licensing is a continuous, business a value creator for us year on year. And I think this is what people have to understand.
But Mishra, again, the reason why I want to be specific on R&D as percentage of total sales is because, analysts who track your firm, they think that the return on ratio, return on equity, because of expenditure or R&D focus will come down.
Well, Well, you know, I think this is something that I cannot answer on a 2-minute interview. I think this needs a much longer explanation because unfortunately in India the understanding of R&D, I'm afraid, is not as it should be. I think the people are getting too used to the very small R&D spends that most generic companies enter into, which gives them big paybacks. But these are gestational R&D spends which have huge and much bigger paybacks. I mean, I'm just giving you an example of the insulin space. I mean, we have actually generated a huge licensing income both from Pfizer and from Mylan now. And I think if you just look at these two and look at the amount we've spent on insulin, it will give you some idea about what the other assets have in store.
And Mishra, now what differentiated Biocon from FY12 and if I compare FY13 was that Mylan deal. So for FY14, are we in for similar deals, similar types?
You know, these are businesses that are bound by regulatory pathways. Okay, we cannot give you any kind of year-to-year quarterly prediction. These are not, these are timing issues. You cannot, I mean, I might do a deal next year, I might do a deal the next following year. But the kind of quantum of these deals is so large that it basically gives you a huge return on investment. And don't forget, I mean, we are a company that is near debt-free. We have actually been able to invest in our capex. And that is something which makes our balance sheet extremely strong. We have $170 million in cash. So I think these are the kind of numbers you have to look at when you look at Biocon. Unfortunately, our stock is somehow not well understood by the markets. Their expectations are by comparing us to generic companies, and unfortunately, I'm not able to do that. So I think we need to look at Biocon as a bellwether stock, a stock that is differentiated, a stock that is focused on R&D, a very, very strong balance sheet with huge value drivers at the end of it.